Hello, everybody, and welcome to another Coffee with Carl. Today, I want to take a chance and talk about something we get quite a few questions about. And that thing today is going to be dealer status. Okay. Uh, a easy, quick description of what dealer status is where the IRS wants to classify you as somebody who is doing real estate activities in such a way where they can classify the real estate you're doing as inventory. So if we imagine a, say, convenience store where I've got, a shelf of Snickers or sodas or whatever, they consider all of that to be done as an active business, meaning that there's some real downside to being tagged as a dealer. Lots of information out there as far as who can be tagged as a dealer, how many deals you have to be done uh, in order to be classified as a dealer. And so we're going to go through some of the different rules, kind of the test on how the IRS looks at it and who's at risk. So number one is dealer status applies to those who are involved on the active side of real estate, meaning doing flips, wholesales, property development, those type of activities that generate active income. And active income is that income that comes along with that 15.3% self-employment tax, or technically it's adjusted to 14.13%, but that's sort of neither here nor there as far as this piece of the puzzle goes. But dealer status can come with some real downside, and there's a real easy way to prevent being tagged as a dealer, which I'll mention at the end. So let's talk about some of the downside of being tagged as a dealer by the IRS. If you are classified as a dealer by the IRS, there are no more 1031 exchanges, no more installment sales. So for those of you who like to do seller financing, there would be no more installment sales. And when I say no more installment sales, meaning you can functionally do the installment sale, except that the entire sale of the property is due immediately, not as you receive the amount for the sale. This produces what we refer to as phantom income, meaning if I sell a $200,000 house and I am a dealer, but I'm doing it on seller financing deal, so say I take 20K down and then I'm holding the note for the rest, the entire 200,000 is taxable and due on the date of sale if I'm a dealer. So you can see how this could be a real bummer if you are tagged as a dealer. Also, you're going to have no long-term capital gains anymore on your real estate. No depreciation deductions are permitted, and there's going to be lots and self-employment tax even on your rental real estate. So we tend to want to avoid to be tagged as a dealer for that specific reason. Now there is a test to determine if you are a dealer, and what we look at for the test, or more specifically what the IRS looks for on the test, is what is the purpose for which the property was acquired, the number of improvements made to the property, number of sales you've done in the past, nature and extent of your business, meaning which way does your business skew? Is it more flips or is it more rentals? The extent of advertising and promotion of the sale of the property, and if you are or are not using a broker. Now, those rules or that test may seem kind of broad, and that's for a specific reason, in that now there's an argument to tag almost everybody as a dealer if they're doing some type of active real estate investing. So, in order to avoid being classified as a dealer, there's a couple ways to go about it. There's really one way to go about it, and that's by using a corporation in your active real estate end. So, that's our solve. We use our corporation not only as a tax deduction vehicle, but also to deal with our active type of real estate investments so that we're not classified as a dealer and we can keep doing our passive activities, meaning purchasing those rentals and getting that passive mailbox money, if you will. So we want to avoid becoming a dealer. There are some benefits to becoming a dealer. They're sort of no matter in that if you're using a corporation, you're getting the same type of benefits anyways. But if you were tagged as a dealer, you would be able to take more deductions against your real estate, or different type of deductions against your real estate because they're inventory, meaning you could do education expenses, selling expenses, commissions, legal fees, things like that. But realistically, we can get that same effect with the corporation without having to sacrifice our passive portfolio in order to get that same result. So Just remember, we want to avoid dealer status. The way we avoid dealer status is by the use of corporations. It's pretty simple, simple concept, artful execution. So if you have any questions, as always, please give us a call at Anderson Advisors. Check us out online, andersonadvisors.com, as well as keep watching content on our YouTube channel. Put out a ton of free content for y'all to consume. Hope you enjoyed it. Once again, I'm Carl Zoellner with Anderson Business Advisors. Look forward to seeing you on the next episode of Coffee with Carl.